Once, Elvin Brooks White had said that the trouble with the profit system has always been that it was highly unprofitable to most people. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we discussed about how management under certain circumstances might choose to deflate current period profits and shift them to later period. In this episode, instead of manipulating earnings to defer or eliminate expenses, we are exploring how companies can increase current period expenses. This involves two main strategies: quickly expensing costs rather than keeping them on balance sheet, and second, proactively recording expenses even if it means inventing them. We are going to discuss two techniques in detail along with examples about how the expenses are inflated. Let's move to the first one: expensing assets too soon for future gain. This financial maneuver involves the improper practice of writing off assets in the current accounting period, essentially treating them as expenses to avoid incurring those expenses in the future period. Instead of accounting for the gradual depreciation or amortization of assets over the useful life, a company prematurely the asset's entire value as an expense in the current period. This tactic can artificially inflate the current expenses, leading to lower reported profits in short term, potentially to lower taxes, while pushing financial benefits into the future periods. In one of the previous episodes, we discussed AOL's questionable financial practices. At that time, AOL was struggling to show a profit and resorted to capitalizing and solicitation costs and essentially inflating the profits by moving normal expenses to the balance sheet. To make matters worse, they extended the amortization period for these costs from 1 to 2 years, further masking their true financial situation. At that point, AOL had over 314 million in the deferred membership acquisition cost. This is a name of an account, quote unquote, I'm repeating again: deferred membership acquisition cost, DMAC asset account. This meant that they had a $40 million hit to earnings each quarter for the next 8 quarters, a significant blow to their modest earnings. So AOL switched gears and played the opposite day game. Instead of sticking to the two-step dance, they announced a one-time charge to write off the entire 385 million DMAC asset, claiming it was due to the changes in their business model. This move raised eyebrows and showcased AOL's audacious financial maneuvers. Unlike the solicitation costs that AOL had improperly capitalized for years, inventory cost most certainly should be capitalized and then later expensed either when the product is sold, most of the time, or when it is written off as obsolete, less frequently. The most common shenanigans with the inventory accounting involve failing to shift the cost from asset account to expense in a timely manner, and this trick naturally would understate the expenses and inflate the profits. In case of chip maker NVIDIA, NVIDIA, they took a significant impairment charge in 2016, citing concerns about older processors becoming obsolete due to a new product cycle. This charge amounted to $112 million, a substantial increase from previous years. However, in 2017, NVIDIA reported selling $51 million worth of previously written off inventory, indicating that their initial impairment estimates were too high. By reversing this inflated impairment charge in 2017, NVIDIA received a 70 basis point boost to its gross margin. showcasing the importance of monitoring such reversals in the financial statements. Management speeds up the recording of expenses for this year by reducing the number of years they spread the cost of assets over and declaring that some equipment is worth less now even if it's working fine. This tactic can make it seem like the company is losing more money in the short term, but it's designed to make future profits look better, making the new leader seem impressive to investors. It's a way to make it easier for the companies to show higher earnings in the future and make the CEO look better than they might actually be. A best example we can find is Chainsaw AI Dunlop. An infamous tenure at Sunbeam serves a cautionary tale in the world of corporate shenanigans. Dunlop, known for his reputation as a turnaround expert, had previously engineered significant stock price increases and lucrative company sales during his leadership at Scott Paper Company. When he took the helm at Sunbeam in 1996, the company's stock price soared by 60%, and apparent improvements led to further investor confidence. However, the truth eventually emerged as accounting irregularities were exposed, resulting in a massive restatement of earnings, Dunlop's termination, and Sunbeam's bankruptcy. This saga illustrates the dangers of unchecked corporate governance and the impact of financial manipulations on a company's long term viability. We should be aware of the restructuring charges as well just before an acquisition. In the previous episode, we discussed how US Robotics withheld revenue to benefit its acquiring company 3Com. However, here is more to the story. Just before the merger, US Robotics cleverly took a $426 million quote unquote merger related charge. This charge, seemingly connected to the merger, allowed 3Com to avoid recording these costs as regular operational expenses post merger. Among these costs, $92 million was attributed to writing off fixed assets, goodwill, and purchased technology. This maneuver effectively reduced the future depreciation and amortization expenses while inflating the net income. So, what did we learn from this technique? First, companies sometimes artificially inflate the current expenses by expensing assets prematurely, avoiding future expenses. This can lead to temporarily lower reported profits, potentially lower taxes, but shifts financial benefits into future periods. The AOL and NVIDIA case illustrates how companies have employed such financial maneuvers to manage their earnings. Second, management can manipulate financial results by shortening the asset depreciation periods and announcing impairment charges on functional assets. This maneuver creates the appearance of short term losses while setting the stage for enhanced future profits, making CEOs' performance seem more impressive than it might be. Third, the story of Chainsaw AI Dunlop's tenure at Sunbeam and US Robotics' actions before its merger with 3Com serves as cautionary tales. They highlight the dangers of unchecked corporate governance and the impact of financial manipulation on companies' long term viability and investor trust. Let's go to the next technique, creating reserves for future expense reduction. In the first part, we discussed how companies use a trick to record an expense today, preventing past expenditures, which are still on the balance sheet, from becoming future expenses. Now, let's explore a similar tactic where company record an expense today to avoid reporting future expenditures as expenses. This strategy involves loading up the current period expenses, taking some from the future, and even inventing some. As a result, when the future period comes, two things happen. First, Operating expenses appear lower than they actually are. And second, phony expenses and related phony liabilities gets reversed, leading to understated operating expenses and inflated profits. Let's delve deeper into these outcomes. Investors usually don't pay much attention to restructuring charges, so companies can gain an advantage by moving certain costs below the main expenses while cutting down on the operating expenses that are more visible. This strategy can make a company's financials look financially better once the restructuring is over. For example, look at the case of Sunbeam, where its operating income soared from $4 million to $132.6 million in 9 months following a restructuring change. Sunbeam's accounting policy changes under CEO Dunlap included a significant restructuring charge in 1996, which was allegedly inflated by at least $35 million. They also created a $12 million litigation reserve improperly. Such practices can give misleading picture of companies' financial health and should be watched closely by investors and regulators. Another strategy involves creating a larger than needed restructuring reserve, inflating future earnings by releasing the reserve strategically. This tactic allows companies to smooth their earnings and shift the compensation expenses from future periods to the current one, classifying them as below the line expenses. Unethical management may exaggerate the charge, doubling the expenses and liabilities. They then release the excess reserves when they pay severance packages to the actual number of employees laid off, effectively reducing the compensation expenses. This unethical practice can help companies meet markets' earnings expectations. Additionally, some companies create reserves at the time of acquisition to manipulate the future earnings. Symbol Technologies, for example, recorded the charges related to its acquisition of Telxon Corporation, including fictitious costs that were used to create cookie jar reserves, artificially inflating the earnings in the subsequent periods. Xerox engaged in similar deceptive practice when it purchased a stake in its European subsidiary, establishing an improper reserve for unknown risks. This reserve was used as a piggy bank to release funds into income when- whenever the company's results fell short of the Wall Street's estimates, contributing to fraudulent financial reporting. Did you know that sometimes the companies can also anticipate the business cycles and the economic downturns? For example, HJ Heinz Company had a foresight that a challenging year was approaching, so they took steps to boost the following year's profit by shifting some cost from the future into the current period. This tactic involves prepaying the expenses to create a better financial outlook for the next year. Additionally, one of the Heinz subsidiaries engaged in other dubious practices like misstating the cost of sales, seeking bill from vendors for advertising improperly, and expensing the invoices for services that hadn't even been received yet. So, what did we learn from this technique? First, companies may artificially inflate their current period expenses by taking some from the future and even inventing some expenses. This leads to lower operating expenses in the future and appear as though the company is operating better than it actually is. Second, some companies create larger than necessary reserves, especially during the acquisitions, to manipulate the future earnings. These cookie jar reserves are used to artificially inflate the earnings in the subsequent periods. Third, in anticipation of economic downturns, companies may prepay the expenses in a good year to make the following year's profit look better. This strategy can involve misstating the cost and improperly expensing the invoices for services not yet received. So here comes the end of this episode. And the key takeaway from this episode is that in the complex realm of finance, companies often resort to creative strategies to manage their earnings, sometimes with significant consequences. This episode has shed light on two notable techniques employed by businesses: expensing assets too soon and creating reserves for future expense reduction. From AOL's bold financial maneuvers to Sunbeam's accounting irregularities, we have learned that vigilance is crucial for investors like you and me and regulators alike. Remember that understanding these techniques is the first step towards making informed financial decisions and safeguarding our investments in an ever evolving financial landscape. Thanks for listening to this episode. In the next episode, we shall discuss about cash flow statements and its manipulations. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.